We had 8 straight years of double-digit earnings per share growth that ended in 2018, and now the outlook looks more like 6%.
So net interest margin, is that going to be the big boogeyman this quarter?
That is the driver. Let's say on average, the banking industry gets 75% of their revenue from spread income. And the second quarter that's about to be reported is going to be the inflection quarter since the end of 2016, where the net interest margin's now going down instead of up.
Because of Fed policy or expectations?
It's the yield
rates,
curve.
Yeah.
It's the yield curve. And when bank stocks were at an all-time high last year, the outlook was look for higher rates, strong economy, more loan growth. Now we've got okay loan growth, but slower. And we've got lower and flatter interest rates in the curve, and that's bad for bank earnings. And so it's slowing down the growth. They're not going to lose money, but it's slowing down the growth in earnings per share.
So today, when we get an upgrade at Morgan Stanley because they're relatively unexposed to lower rates, is that a smart call?
I think it is. I think the further away you get from the yield curve right now, the better. But here's the other thing, is that what I just said, I don't think is unknown. In other words, bank stocks are 20% below the performance of the overall market. We're talking about the stock market at an all-time high. Hardly that's the case for bank stocks. So there are a lot of really good companies that are caught up in the sector wave that I think, frankly, are just they're trophies that are on sale.
Like who?
Well, so we do have a couple. One is, I'd say our favorite's Western Alliance Bancorp, which is a 20-something billion-dollar bank headquartered out in Phoenix, Arizona. They haven't missed a consensus estimate in about 6 years. They earn 2 on assets, 19 on equity, trade at a high single-digit PE, still growing. We think it's a very good company. That, M&T, another one is Center State in Florida, really good. What I would do is, in a tricky environment, is bet on the good management teams, because they tend to figure it out, and you're getting the discount and the valuation from the whole sector being out of favor. So now's a good time to be a stock picker.
Are you convinced after the week and Powell's testimonies that the cut is assured? Because the data's run warm here and in Europe. Bostic and Barkin are sort of trying to swim upstream a little bit today.
In listening to that testimony and reading his testimony, I think he was dropping breadcrumbs that if he didn't cut rates in July,
there'd be a revolt.
The market would have to adjust to that news and understand what just happened. Now, I'm not on the parade that says we're just going to get a whole series. I think they will cut, and then they'll be somewhat data dependent, with the tendency to lean towards easing, because we don't have inflation, and I think an insurance policy is not a bad idea.
So just on banks, obviously that's going to pressure their bottom lines, as you mentioned, especially those lower rates. How do you balance that with some of the other positives, like IPO fee activity, which has probably exploded in the last quarter?
Yes. So the industry, even though the growth rate in earnings per share is slowing, the industry is very profitable. I mean, we've recovered all of the profitability in banking since the crisis. So the industry is going to remain at a high level of profitability with slower growth. Offset for those banks that do IPOs and things like that will help. But there is a caveat. The caveat is there's almost no credit expense. And so you need a steady economy to keep that story going. If you wanted to know, say, Tom, what could be a surprise in the quarter, we did have a blip up in some non-performers in the first quarter. We see more of that in the second quarter. Investors will start wanting to think more about what's happening with credit.